Welcome to another video on the channel, and in today's video we're going to be going over hedging as an intelligent investor. So we're going to be going over what is hedging, why should we include a hedge in our portfolio, and why is this important in general. So let's just get straight into it. So what is hedging the market? So this is a great question. This is basically, if you're a long-term investor, it's having a short position, like a short-sighted position that would offset your losses if the market were to go down in a specific amount of time. So is this the same as a hedge fund? No, it is not the same as a hedge fund. People will get that confused. A hedge fund is basically a fund that will, have, quick investments and just try to generate as much money as possible from like a stock market or the markets in general, right? Not hedging where we are shorting the market basically, like having investments that would benefit if the market went down. So, and another question that people ask is, why would I want to short something if I'm a bull, right? Obviously, if you know me, I'm very bullish on the stock market. I don't I 95% of my investments are, I'm investing that the market's going to go up. I'm very bullish, obviously, in the long run. If you're an investor, why would you be short sighted? Even Warren Buffett says he would never bet against America. It's not a thing. So why would I want to short this? So let's get into the definition. So it's an investment that is made with the intention of reducing the risk of adverse price movements in an asset. Basically, this hedge in our portfolio would offset our let's say we're investing, we are betting that something's going to go up, but it eventually does go down. We would have this hedge that would be as like a comforter in our portfolio that would actually generate us some money as a security is going down. So this does not involve day trading, right? This does not involve day trading whatsoever, and we will get into why and how this works in just a moment. So let's get straight into it. So, for example, a YouTuber that I watch, his name is Jeremy. He placed some put options. If you don't know what put options, basically there are options that are, you're betting that the market or that the stock is going to go down. You're going to make money if the stock goes down. And it was on Toll Brothers, right? And he had done this because of, higher and higher mortgage rates, and he ended up being right. And he made money, even though he was invested in many stocks, he was long in many stocks, he still made money even though, this stock went down. So he earned more money that he can invest into other stocks. So let's get into the rules for hedging though. So the main rules that I set when I'm doing this is that you're going to want to buy options contracts, right? Put options contracts, or you're going to want to sell calls, right? You do not want to short the stock. So when I say I'm shorting a stock, that doesn't mean that I'm short selling where I'm clicking the button where I'm short selling the stock. No, I am buying put options, right? Options that are usually close to being in the money, and they are puts that I'm betting that the stock will go down to that price. So why am I doing this? Because think about it. If I am a bull, like we were saying earlier, I don't think that the market is going to go down for a very long time, right? I think that, for example, or any of the stocks that I am, placing hedges on, I don't think they're going to be going down for the long run. I think there's just a short-term thing that will happen. So I want to buy options contracts that are set on a certain date, right? All options contracts have an expiration date to them, where if you short sell, that's for as long as you want, right? Like, as it's like holding a stock. So that's why options contracts, they can generate you a lot of money in a short amount of time, right? So this is why we are buying options contracts, because we are not like, long-term shorting these stocks. No. So the next part is, do not oversize your position. When I'm buying these options contracts, I am not spending more than like 5 to 10% of my portfolio. You do not want to be spending too much, because think about it, obviously we are still bullish. We want the market to go up, but obviously, if the market does dip, we will be making some money that we can reinvest into our stocks later. And the next one, do not be greedy. And I said you could be greedy as much as you want with shares, but not with options, right? If for example you place a put on a stock, right, and it goes far, right, you're over like 100% gain on your contract, you should just sell, right? Do not be greedy, because think about it, we are still bullish investors. We do not want to be, we do not want to be long term, be like, oh, I'll wait for it to go lower. Like, you do not want to wait for that, because eventually the stocks is going to go up, right? And I say, yeah, you can be greedy as much as you want with shares. So think about it. Shares, you can own them for as long as you want. If you buy a share of Tesla, you own that for as long as you want. You can own it for 10 years, 20 years. There's no a certain time where you have to sell, right? Whereas options contracts, eventually the contract will expire, right? Which makes sense. So, and the next one, these should be long term, but not as long term as your leaps, right? So these should be, so leaps, right? Those are like options contracts that are, that you're betting the stock will go up, but for like more than six months or more, right? Expiring. But these put options, these hedges, they should be long and not too long term, right? I don't know why I said like long term. They should be like mid term, right? So for example, these options could be like a month out or 2 months out, something like that, but nothing crazy, right? But also you don't want it to be too short where it's like, oh no, we have like a week, right? But yeah, so I'd honestly say like a month. A month is a good amount of time. Or a little bit more, but not, you don't want to go like more than like 3 months, because then you're getting a little bit too long term. But also, yeah, like you don't want like a 5 day out, expiration. Like that's gambling at that point. You know what I mean? You don't want to get into that. But yeah. So most importantly, you need to have a catalyst before you even consider a hedge position. So this is like the most important thing too. So when you want to hedge the market, you don't want to just be like, okay, let me buy a couple put options of like a S&P 500 ETF, or let me buy a couple a couple put options of like some big market cap company like a Google or something like that, right? Like, no, you should have a catalyst, right? By catalyst, I mean like there should be like a specific reason as to why you're buying that company, why you think that one would be going down in the next, like month or so, right? So for example, the YouTuber I was showing you, Jeremy, his catalyst was that these companies, he didn't just choose it randomly, Toll Brothers. He chose it because of higher mortgage rates, right? Because that's a home builder stock. So higher mortgage rates would actually negatively affect the company. So for another example could be like the change of a CEO or a significant change of the business model. For example, like Chipotle, they changed the CEO, and people benefited from hedging, the Chipotle stock, right? For example, they thought it was going to go down. And yeah. So why am I bringing this up, and what am I doing currently? So what I am currently doing is I am actually buying put options on these three companies: Chubb, Allstate, and Travelers. So why am I shorting these very popular insurance companies, you may ask, right? I'm shorting them obviously because I live in LA and because of the LA fires, right? For example, someone had told me that, they're going to be, I had actually read that, yeah, actually right here, they're going to be paying up to 10 billion in losses, right? Think about it. They're going to have to pay these people whose houses just burned down, right? So yeah, and as you can see in this article, I'm pretty sure it says, yeah, JP Morgan analysts highlighted like they highlighted these three: the Allstate, Travelers, and Chubb, right? Like this also wasn't the main reason that I chose these companies, but it's also like because I looked at their balance sheets and income statements and I saw very little growth. And also, yeah, so I just, I do want to place a little hedge on the market as we go into Q4 earnings. So yeah, this hedge is more for me just, as we go into Q4 earnings, there's going to be volatility in the market and we might see a quick drop. And okay, so if that happens, most likely these insurance companies will follow the stock market and they will drop, and I will be making money. And what I would do with that money that I would be making is that, first of all, I would sell these contracts pretty early, and I would transport this new capital that I have into just more stocks that I'll probably be buying at a lower price because the market went down, right? So yeah, and even if I'm not right and I end up being wrong, okay, most likely if these companies are, going up in value, then that probably means most of the market is going up in value, and I'll probably be making money on my regular investments in general. So realistically, it's a win-win. Think about it, the market goes up, I'll be making money from my my investments, my leap options. And if it doesn't, then, I'll be making money on these that, these are very temporary. These are temporary options contracts that I'll just send into, Tesla or Nvidia or any other of my big positions, right? So yeah, that's basically it. Here I've put a book that I love reading. It's The Intelligent Investor. It's a great book. You should definitely pick it up if you want to get more serious about investing. A lot of great lessons to be learned. And I put this picture of Virgil Abloh where it says, "Don't do it for them, do it for you. Everything I do is for a 17-year-old version of myself," and I'm 17 right now. And I'm posting this, so one day in the future I can look back on it and be proud. So thank you so much for watching, and I'll catch you in the next one. See you.